All right, again, cost volume profit analysis is the study of the effects of changes of costs and volume on a company's profits. Cost, as it relates to volume, volume being the level of activity, and the effect those two have on profit. And it's very important for management in planning future courses of action, in planning how to increase profits. Of course, it's very important. We know the relationship between sales and variable costs and fixed costs. Setting our selling price will determine what our contribution margin is. If I have more than one product, which product do I produce? If I have a choice between one or the other, therefore you can determine what the product mix, the ideal product mix should be for a company by understanding that the contribution margin per unit of each product is different. And it also helps us maximize the use of production facilities. Again, if I'm producing more than one product, I know the selling price of the product and the variable cost, so I have a contribution margin for each product. But the fixed costs are common to all products. So you see, fixed costs support all the products that are being produced in the factory, but each product has a different selling price and a different variable cost, therefore a different contribution margin. So then how do I make the best use of my production facilities? Which product do I produce more of if I can sell it? Those are questions that come into play for management. Now, we want to look at the cost volume profit model and the basic components of that model. Today we're going to deal with 4 of them. Next class we're going to deal with sales mix. Well, the 4 is simply this: sales, the volume, the level of activity, sales or production. We need to know the level of activity. We need to know the unit selling price and the unit variable costs and the total fixed costs. Now notice, when we talk about variable costs, we talk about it on a unit basis. When we talk about fixed costs, we do talk about it on a total basis. But those are the 5 components we're going to deal with for today. And we introduce in the next class sales mix and operating leverage concepts. All right, so basically, the assumptions we're going to make here, simply put, is that I am able to break all the expenses in my company with reasonable accuracy into either variable or fixed costs. And I assume that any change in these costs, that change is solely related to a change in activity. We also assume here that all the units we produce, we sell. They're expensed. We're not holding any units back in inventory here, which would have an effect on the total cost of the product. Because if you hold them back, then you're holding fixed costs back. You're not releasing them. Okay, question 4. True or false? We just said that. All right, what do we got? I hope everybody got that one right. Very good. Good. Okay, let's move on. Another question. Again, in CVP analysis, the term costs include manufacturing costs, which are product costs, and selling and admin, which are period costs. Now, is that true or is it false? Some people think that it only includes manufacturing costs. No, it includes all costs. No, the answer is, it is true. When I talk about cost volume profit analysis, I'm talking about all the costs in the company, the product costs and the period costs. Now, we're able, once we can define or distinguish a variable cost and a fixed cost, to reformat the income statement and come up with what's called the contribution margin. And here's an example. I have Vargo, produces high definition camcorders. It has a selling price of $500, a variable cost of $300, fixed cost of $200,000, and a volume of $1,600. So you see, I have my four components here. I have my volume at the bottom, I have my unit fixed selling price, my unit variable cost, and my monthly fixed cost. So I can now format the income statement into what's called a cost volume profit income statement. That's exactly the same as the regular income statement. So we have sales of 1,600 camcorders, 800,000. The variable costs on those 1,600 is 4,800, or 480, sorry. 480,000 gives me a contribution margin of 320,000 minus my fixed costs gives me net income 120,000. So that's my CVP income statement. Question number 6. That statement classifies costs as variable or fixed and computes a contribution margin. Now, everyone should get this one right. True or false? Allergies. True. Yeah. Of course that's true. No trick. That's what it is. Now, we introduced the contribution margin in total, but we can break that down now and look at the contribution margin per unit. So we're looking at a unit basis, and it would be the difference between a unit selling price and a unit variable cost. And in that way, I get my contribution margin per unit. Question number 7. Unit contribution margin is the amount that each unit sold contributes towards recovery of fixed costs and to income. True or false? Yeah. Oh my goodness. That is true. I'm telling folks, you better get onto this material because it's all going to be on the midterm. And I noticed a lot of you did not do the in-class assignments from last class. You're going to have more of this class and an assignment on all of this. All right, so now we can look at the contribution margin in total. We can look at the contribution margin per unit. Now, when I have it on a per unit basis, basically every unit in comes 500. Every unit I sell, in comes 500 in cash, and I need 300 of that 500 to pay for the variable costs. And once I do that, I have 200 left over. Now that 200 contributes to covering the fixed. So all I have to do now is to figure out how many units I need to sell to cover my fixed and give me a zero profit. I simply take the fixed cost, 200,000, and divide by the contribution margin per unit, and I will get 1,000 camcorders. When I sell 1,000 camcorders, each camcorder contributes $200, and therefore the total is 200,000, and that equals my fixed. So when the total contribution margin equals the fixed, I'm at zero profit. The next one I sell beyond that level. When I sell 1,100, Well, that extra one now, I have $200 and I don't need it to cover the fixed, and therefore it's profit. So therefore, every camcorder that I sell beyond my break even, beyond 1,000, the contribution margin per unit is the profit times the number of units beyond break even. All right. So in that way, I can predict my profit. What if I sell 1,500 camcorders? Well, that's 500 camcorders more than I need to break even. 15, I need 1,000 to break even. I sell 1,500. So I've covered my fix at 1,000, and on the other 500, I earn 200, and that would be 100,000 in profit. I believe something close to that. All right, now we also look at the contribution margin in terms of percentages. Now, when we talk percentages in business, we talk ratio. And every time I'm talking ratio, whatever kind of ratio I want, I mean that item as a percentage of sales or selling price. So I can look at this two different ways. I can look at it on a unit basis. I know that for every unit I sell, I get a contribution margin of 200. Well, what is that 200 as a percentage of selling price? Well, the selling price is 500. So that contribution margin ratio is 40%. What that means is every dollar I sell, 60% goes to cover my variable costs, and 40% is contribution. Now, I can look at it on a unit basis. I can look at it in total. It will be the same percentage. For example, here, sales is always 100%, always. And if I take my contribution margin, $200,200, divided by $500,500, I get 40%. So now I know the percentage, and that will remain the same percentage all the time, unless I sell my, I change my selling price or I change my variable costs. At all times it'd be 40%. So this is the contribution margin ratio. That is the contribution margin as a percentage of total sales. Now the complement of that is the variable cost ratio. What's the variable cost ratio? It's the variable cost as a percentage of sales. And of course, it's the complement here with the contribution margin. So in this case, it's 60%. So again, every time I make a sale, let's say if I make $1 sales, 60 cents goes to cover my variable cost, 40 cents remains to cover my fixed costs. All right, so there's the new terms: contribution margin per unit, contribution margin ratio. Now the contribution margin ratio of 40% means that 60 cents of each sales dollar is available to cover the fixed and produce a profit. True or false? Yeah, it's false. It's not 60% of each sales dollar is available to cover the fixed. 60 cents is what the variable cost would be on each sales dollars. 40% is what would be the amount available to cover the fixed. Okay. So now let's revisit all of this, and we can look at the changes now. So here we have Vargo, and Vargo right now has 500,000 in sales. So you see on the left-hand side, the no change, you have sales 500,000, variable costs 300, contribution margin 200, fixed cost 200 on a per unit basis and as a percentage of sales. Now, with that knowledge, we want to look at the effect 100,000 increase in sales would be on my financial statement. Well, this is what I can predict. If I increase my sales 100,000 by 200 units, well, my variable costs will also increase, all right, from 300 to 360. Notice, okay, that I have a 40% increase in sales. And therefore I get that same thing. So now the contribution margin is 240. The per unit is the same, percentage of sales is the same, but my profit now is 40,000. So basically, another way of looking at that is at $500,000 in sales, I'm at break even. So therefore, any increase in sales beyond break even, 40% will be profit. 60% will be needed to cover my variable. And that's what you have on the other side. So 40% of 100,000, and that 100,000 is sales beyond break even, 40% is the profit. So I can predict the profit very easily when I have the income statement in this format, and I use the contribution margin and the contribution margin ratio. Okay. So now we're going to look, okay, we want to determine the level of activity, the volume, where we have zero profit. So break-even analysis is finding that point, that level of activity in which total revenues equal total costs. Now the total costs, remember, are both fixed and variable. We're going to demonstrate it with the mathematical equation, but what I want you to focus on is the contribution margin way of doing it, okay? Now we're going to express break even in two different ways. Break even in the number of units I need to sell to get zero profit, and break even in the number of sales dollars I need to achieve to earn zero profit. Okay, so now here is the basic equation. Sales, now I know I'm going to let that level of activity be Q. I don't know why they didn't make it X, but they make it Q, I guess, for quantity. 500 Q, number of units, 500 times the number of units, minus the variable cost times the number of units, which is 300 times the number of units, equal my fixed cost plus zero profit. That's the mathematical formula. There's the total revenue minus the total variable costs equals 200,000, and I get that. So when I solve for Q, 500 minus 300, I get 200 Q. And that equals 200,000. To get the amount of 1Q, I simply, or to get the Q, 200, I divide the 200,000 by the 200, and I get 1,000 units. Well, you notice that the 200 here is what we call our contribution margin now, 200. So the formula basically is fixed costs divided by the contribution margin per unit. And so when you have those kinds of things, a contribution margin technique is simply that. The break-even point is that where the contribution margin must equal the total fixed costs. So we can do it either on a unit basis or a percentage basis. So the contribution margin technique is simply this. If I want to know how many units are required to break even in sales, that is, then I simply divide the fixed costs by the contribution margin that I earn on each unit, contribution margin per unit. And my answer will be in units. The answer is 1,000 units. Once I sell 1,000 units, I have earned enough contribution margin to cover my fixed costs. If, on the other hand, I want to know how many sales dollars that I have to sell in order to earn zero profit, well, maffe muskila, I use the ratio. That's all I do. I take the fixed cost, 200,000, and divide by the contribution margin ratio, 40%. And I get my answer in dollars. It's the same break even. 1,000 units that I sell at 500 a unit is 500,000 in total sales. So I'm expressing the break even two different ways. I'm first expressing it in units. If I want the answer in units, I use the contribution margin per unit. That's all. And divide that into the fixed cost. If I'm asked what level of sales dollars do I have to achieve, maffe muskila, fixed costs divided by contribution margin ratio, 40%. And my answer is 500,000, the same thing. So there's your break even. Now, let's start the quiz. So you see how valuable the contribution margin is. The break-even point is where total sales equal total variable costs. True or false? Think about it. Right. Break-even point is where total sales equal total costs, both fixed and variable. Okay. Do I have another one? What happened to my leaderboard? I guess I don't get my leaderboard. Nope. Okay. I messed that up. All right. Here's another example. Lombardi Company has a unit selling price of 400. Remember, I need unit selling price. I need unit variable cost. I need the fixed cost, and I can determine the volume. So Lombardi has, first of all, the selling price, 400. The variable cost, 240, and the fixed cost of 180. Well, what I need is the contribution margin per unit. So compute the break even with the contribution margin per unit. Well, that's simply 400 minus 240, which is 160. So my variable cost is, my fixed cost is 180. My contribution margin is 160. There's my answer in units. If they wanted it in dollars, then I would take the 160 as a percentage of selling price and get the ratio and divide the ratio into fixed costs, and I would have it in dollars. All right, that's fine. That gives me zero profit. That's what break even is. But for management, we're adding value to the company. So we use this now, not just to figure out what I need to break even, but we also use it to figure out how many units I have to sell to earn a certain target net income, or how many sales dollars do I have to achieve to earn a certain target net income. So the target net income is that level of sales necessary to give me the profit I want to achieve. And we're going to do it just based on contribution margin, never mind the mathematical. Basically, this is it. The mathematical equation, required sales minus variable cost minus fixed, gives me my target net income. But if I look at it mathematically, I go through the same exercise, and you will notice that when I do it, it's fixed cost plus that target net income divided by the contribution margin per unit. That's all. That's right. It's all I need to do to determine the level of sales is to add the target net income to the fixed costs. That's all. I need contribution margin to cover my fixed cost and give me a certain level of profit. So let's assume now we want to earn 120,000. Fargo wants to earn 120,000, and they want to know how many units they have to sell in order to earn 120,000. Well, keep in mind my fixed costs were 200 and my contribution margin per unit was 200. So basically I need to know the number of units that I need to sell to cover my variable cost, cover my fixed cost of 200 and leave me with a profit of 120. And as we demonstrated before, that was 160 or 1,600 units. If I needed it in dollars, again, fixed cost plus target net income, but this time divided by the contribution margin ratio. And my answer is in dollars, and you'll recognize that's the financial statement we started off with. Okay, again, start the quiz. Question 10 of 12. Required sales dollars to meet target net income is computed by dividing fixed cost plus target net income by contribution margin per unit. Wait a minute now. They want sales dollars. Variable cost plus target net income by contribution margin per unit. They want sales dollars, so I got to use the ratio. Fixed cost plus target net income by contribution margin ratio. 18 people. Oh, come on now. All right. No, the answer is fixed cost plus target net income by contribution margin ratio. When they want dollars, they want the sales in dollars, you use the ratio. These two we're talking about the contribution margin per unit. So you use the ratio. Okay, somebody's happy. All right, Ahisham, Alanud, she probably did. Islam, Amna, very good. Sarah, Anna, Rashid, Alija, and Ferris is still under the weather, so he's forgiven. So, okay. All right. You have a good idea on target net income. Keep in mind, if I ask target net income in units, then you use contribution margin per unit. But most often, we talk about we talk about target net income in sales dollars, because that's what we're generally dealing with. And like before, if you want to determine how many sales dollars is required to give me a profit of 120,000, you divide the fixed cost by the contribution margin ratio. Keep in mind, ratio is a percentage of sales dollars. Now we look at another concept. And this concept is kind of relevant to our economic environment today. And that is, once I understand the level of activity I need to cover all my costs, that's break even, and I am selling beyond that, hopefully I am making a profit, I want to look at what we call the margin of safety in a business. Now, the margin of safety is basically the difference between the sales I'm doing now and the sales I need to break even. Now, hopefully the sales I'm doing now are more than what I need to break even, hence I'm profitable. Or if I'm looking into the future, the margin of safety, is the expected sales next year more than what I need to break even. All right. So this actually is an evaluation by business people of a risk that a company currently endures. So another way of looking at it is this is a cushion for the company. If, for example, I have two companies, the break even is 500,000 in sales, just to make it up. One company right now is doing 700,000 in sales, and the other company is doing 900,000 in sales. So you can see the first company, sales, if they drop 200,000, that first company would be at zero profit. But the second company would still be in profit, because if it dropped 200,000, that second company's sales are 700, and they need 500 for break even. So you would say that the first company, the one that's doing 700,000, is at greater risk of ending up in a negative position than the other company. Now, before this virus, you walked around the local mall, and a year and a half later, with all this virus and shutdowns and everything else, you visit the local mall and you'll notice quite a few businesses are no longer there. Those businesses that are there were businesses that had a larger margin of safety than the other businesses, because business falls generally for all companies. When the economy declines for all companies, those companies that are operating just above break even will fail earlier than those companies that are operating quite a bit more than break even. Well, that difference between what they're operating and their break even is called the margin of safety. And we generally express this as a ratio, okay? So here in this example, we have a company that has a break even of 500,000, and has actual or expected sales of 750. So we take the absolute dollar value of that margin, which is 250. We could say sales would fall 250 for that company. But it's more often expressed as a ratio. What's a ratio? Ratio is a contribution margin. I'm saying margin of safety ratio is the margin of safety as a percentage of sales dollars. So this company is doing sales dollars of 750,000, which is 250 beyond break even. So the margin of safety is 250 divided by the actual sales, 750, and I get 33%. So the economy would have to decline by more than 33% before this company falls below break even. That i.e. is in the negative range, is in what we call the red. The old accountants would do the books and the blue pen. If there was a loss, they would highlight the loss with a red pen. So that's where they get in the red, which means you're in a loss position. So you see, the higher that percentage, the greater the cushion the company has. And I would estimate that these retail stores and so on in the local malls were probably operating with a margin of safety of 10 to 15%. Because we saw a decline in the economy of anywhere between 20 and 25%. Okay, so that is the concept of margin of safety. If you were around and aware in 2008, 2009, you people in Dubai, we had a financial crisis in 2008, 2009. And you could see all the cranes in Dubai stopped. Basically, a lot of those construction companies failed to continue to operate. They went under. And that's because they may have been profitable in the future, but the profit was only that much beyond break even. So this margin of safety is a very important concept. And it comes about by analyzing the sales I'm doing now in excess of what I need to break even, and assume that the economy will decline. And if the economy continues on like it was before the virus, these companies that were operating with a margin of safety of 10 and 15% would be doing okay. But you say, nobody knows what happens with the economy. In the last 15 years, we had a major shock to the economy in 2008, 2009. And with who would have predicted this virus in 2019? So the margin of safety is a very important concept, one that you should be aware of. Okay, let's finish off. In evaluating the margin of safety, the higher the margin of safety ratio, the greater the margin of safety. The higher the dollar amount, the lower the margin of safety. The higher the margin of safety ratio, the lower fixed costs. It's got nothing to do with fixed costs. So the answer is 3, 2, 1, time's up. And the answer, very good, very good. All right. Okay, then leaderboard. Okay, good. All right, the last question. Dan, get your calculator out. Dan's lawn equipment, total sales of 400 and a break even of 280. How much is the margin of safety ratio? So now you have to come up with margin of safety in total dollars, and then ratio means percentage of sales or selling price. In this case, it's a percentage of sales. And the answer is right. Very good. The margin of safety is 400 minus 280, which is 120. And you take 120 as a percentage of 400, and you get 30%. Okay, there we go. I think we have our winner. Yes, Hisham, congratulations. I think you won it last time too. You like this stuff, right? Okay, good. All right. Well, that went rather quickly. That's okay, as long as we cover the material. That's all we want to do here. All right. I need to move on to Socrative. So we'll do Socrative, take the break, and then we do the problems in Wiley, and that will be it for today. Any questions?
Doctor, what's included in the midterm?
Midterms next Saturday, 10 a.m.
Which chapters?
Everything we've taken.
The salon gave 3,500 haircuts, shampoos, and permanents at an average price of $45 during the month. Fixed costs were 33,750 and variable costs were 75% of sales.
Okay. All right.
So, A, determine the contribution margin in dollars per unit and as a ratio. Round per unit value to 2 decimal places.
Okay.
Okay.
Obeyed. This is the easy one to start with is the contribution margin ratio. Remember, selling price is 100%, variable cost ratio and contribution margin ratio have to add up to 100. So you don't have the contribution margin ratio, but you do have the variable cost ratio.
So it will be 100% minus 75%. It will be 25%.
Exactly. Now that you have that, you can figure out selling price. You can figure out contribution margin per unit. Okay, so if the selling price is 45%, 45, the variable cost ratio is 75% of that, and therefore the contribution margin ratio is 25% of the 45.
One second. I'm gonna calculate it.
Yeah.
Okay. I think I got it wrong, doctor. Is it $45 divided by 25%?
No, not divided.
25% of the $45.
Right. So how much is that?
18%, doctor?
I don't know. 25%, 1/4 of 45. No, it wouldn't be that. Your contribution margin ratio is 25%. So therefore, the contribution margin per unit would be 25% of the selling price. What's the selling price?
It's $45
Right.
per unit.
Yeah.
Times 100,025. It's still 180, it says, but
What?
I think it's
No. 0.25. It'll be 1/4 of 45, which would be 11/12, something like that. Anybody help them?
So عباد
نعم.
الكونتريبيوشن مارجن بير يونت او
انا عرفت يا ري، بس ما عرفت كيف اقسمها بالتليفون بالحسابه.
شوف الثاني واحدة البير يونت بس سوي ال 45 الافريج برايس تايمز الكونتريبيوشن مارجن ريشيو
اللي هو ال 25.
ايوه
بيرسنت. اوكي، بس طريقه حسبتها في الحسابه كيف؟
45 تايمز 0.25.
اوكي،
هاي ثاني واحدة مش الأولى.
هاي اوكي، بس الأولى بتكون 45 divided by
Not divided.
كيف نطلع البرسنت من ال 45؟
شوف أول واحدة تاخذ اليونت برايس تضربه بالكوانتيتي، بعدين تضربه بالريشيو اللي هو 0.25.
اوكي. It will be Dr. 11.25.
Okay, that sounds better.
The contribution margin.
هاي ثاني واحدة 11.25. الثانية 11.25
هي اللي هي per unit margin.
Yeah. Right.
In dollars it will be قلنا اللي هو ال 45 times the haircuts.
او تشوف عباد فيك تعملها من الكونتريبيوشن مارجن البير يونت 11.25 اضربها بالكوانتيتي بس.
Right. Quantity. For
Okay.
every haircut, I make 11.25. So what's the total contribution I get?
تقريبا 39,375.
375 هي. It will be 39,375.
Is that right? Okay, let's see. Yeah, very good, Obey. Very good.
B, using the contribution margin technique, compute the break-even sales dollar and sales unit.
Okay.
Okay, so the break-even sales dollar, it will be the contribution margin. ضعت أنا. I'm kinda lost, Doctor here.
Okay, well, what's the break-even formula? In units?
The
Hey?
break-even it should be the profits and let me check
No,
it, Doctor.
no.
I can't, Doctor, remember every rules. I have bad memory. I
That's
really
okay.
do.
That's okay. Go back to your formula. What's the break-even in units?
Break-even in units.
Go back to the PowerPoints if you want.
Break-even point, contribution margin must equal total fixed cost.
Okay, so you need the fixed cost?
Okay.
And you want the answer in dollars or units here?
Let me see. It will be in dollars.
Okay, so you use the ratio. That's all. So what's the formula?
Cost هشام ساعدنا يا هشام.
وين أي سؤال عباد؟
اللي هو هذا ضيعت يا اخوي.
تمام، البريك ايفن سيلز بالدولار.
اعرف القانون بس هذا الشغله هني هم.
هو شوف، تعمل الفيكست كوست
اوكي.
تقسمه على ال contribution margin per unit.
No, it's dollars they want.
It's dollars.
Contribution margin ratio.
اوكي، مع الريشيو.
انزين بيكون هذا
لا،
بيكون
fixed costs. Yeah, get the fixed cost.
بيكون هذا الفيكست
divided by 0.25.
That's all.
الcontribution margin ratio.
0.25.
صح.
Right.
اوكي.
تعطيك البريك ايفن بالدولارز.
150 تصنيف 0 33 750 25 يعطيك 135,000.
Okay, what's your answer?
It will be, Doctor, the total fixed cost.
Right.
Divide 20 with 25% of it.
Right.
Okay. 135,000 صح؟
صح.
Okay. And now we want it in units. So fixed cost divided by the contribution margin per unit. That's all.
It will be 33,750.
Yeah.
11.25. It will be 3,000.
Is that units? Okay.
Yeah.
So correct. Very good, Obed. All right. Now they want the margin of safety. So I need to know what sales. I compute the margin of safety in dollars and as a ratio. All right. So I know what my break even is in dollars. Okay, what's my break? Yeah.
The break even, Doctor, is 100.
Right. What's my sales now?
My the sales
معطيك اياها فوق اول شيء.
3,000. The number of sales, Doctor?
No, the sales dollars.
Yeah, 33,750.
No, that's the fixed cost. That's the fixed cost.
Yeah.
How many haircuts did I sell?
3,500.
How much did I get for each haircut?
$45.
Therefore, what's my total sales?
Let me. Will be 3,500 multiply with 45.
Right.
It will be 157,500.
Okay, now that's my sales. Now, what do I need to break even?
Your sales, doctor, with the
No, my sales. You just calculated my sales. Now, how much?
Okay.
What's my break even in sales? You calculated that too. Right. Yeah, go down. Break even in sales.
this one, doctor. In
Right.
dollars.
So what's the difference?
It will be 22,500.
Okay. Right. And if they want that as a ratio, then you take that 22.5 as a percentage of sales. So you got the sales there. You already calculated the sales, you said.
Yeah. 1 second, doctor.
Yep.
350. And it will be 25%, right, doctor?
I don't know. You take the margin of margin of safety in dollars and divide it by the total sales.
عباد قد ايه طلع معك التوتال سيلز؟
total sales طلع عندي 157,500 157,500
Okay.
dollars. This is my total sale.
وتحت قديش طلع معك margin of safety 205
In dollars, it will be 22,500.
Yeah, but they want it in
But
ratio.
the ratio.
تمام. اقسم margin of safety in dollars by total sales.
Okay.
So it will be around
7.
14%. margin of safety divided by the total sales اللي هو اللي قلت لي عنه 157,500.
اوكي بيكون تقسيم اللي هو
المارجن اوف سيفتي تقسيم التوتال سيلز
22,500.
Right.
It will be 7.
7
طلعت عندي 7.
يمكن
Is
انا
that
عامل
all?
على بعض.
Let me try it. 7 is wrong. So I divided, doctor. I divided the whole the number I got from here with the margin of safety in dollars.
No. You take the margin of safety in dollars, okay, and divide it by the total sales in dollars. What's your total sales in dollars?
157,500.
Okay. Take 22.5 as a percentage of that. Divide it.
يعني المارجن اوف سيفتي ان دولارز divided by التوتال سيلز، يعني خلي التوتال سيلز اللي تحت.
Yeah, what do you get?
تطلع معك في 14.
500. It's 0.14 صح؟ صح هشام؟
There you go. That's your percentage.
حط 14.
14 ها؟
يس لانه it's a percent.
14? Yeah. Oh, okay, good. Very good. All right. Any questions? Okay, we got more then. Let's go move on.
Current attempt in progress. So Maria Willis is the advertising manager of Bregain Shoe Store. She currently working on a major promotional campaign. Her ideas include the installation of a new lighting system and increased display space that will add $30,400 in fixed cost to the 272,000 currently spent. In addition, Maria is proposing that a 5% decrease from $38 to $40 will be produce a 20% increase in sales volume. To 20,000 to 24,000 variable cost will remain at 24 per pair of shoes. Management is impressed with Maria's ideas, but concerned about the effect that this change will have on the break-even point and the margin of safety.
Okay, good. All right. So now build the income statement.
Prepare the CVP income statement for current operation and after Maria changes are introduced.
Okay, good. Very good. Okay, so CVP statement, sales, variable costs.
Variable cost.
Contribution margin. Variable, okay.
Variable cost. And then, doctor, so we put here sales and variable expense. There is
Okay.
no variable costs.
What's that give you then?
Sales, let me see. The display that will add fixed to the percent. It's in sale volume. هذا بيكون السيل هشام 200 fixed
Can you
cost
make
to
it,
the
can you make it larger for me?
yeah, 1 second.
Okay, good. Okay, now the sales. The sales right now is $40, right?
That 5 increase to will be produced.
Yeah, but you want current now. You want the current, so.
So it's 40 times 20,000.
كيف طلعناها؟ How did we get it, doctor? Can I?
The old price.
Yeah, 40 times.
Old volume. The old
The
volume.
old volume, yeah. What's the old volume?
اللي هو 30
لا تحت. كمل.
No.
20.
Right.
Okay. 40 times 20.
هذا
هذا السيلز هشام؟
الكرنت سيلز 40 ضرب الكرنت فوليوم اللي هو 20,000.
800,000.
Okay.
When new, it will be doctor 38.
Okay.
Multiplied with 24,000.
That's right. Good.
That's the current. 912.
Okay. Now the variable costs.
The variable cost.
The variable cost will remain 24 per
pair of shoes.
Okay, so how many shoes did I do in the old current?
In the old, they did 20,000. In the current, they did 24,000.
Okay. So multiply by 24.
Okay, 20,000. 24. It will be 480,000.
Okay.
And here it will be 576,000.
All right. So sales minus variable cost gives me what?
Profit.
No.
Contribution market. Margin.
All right.
Okay.
You got to cover your fix before you get to your profit.
So it will be 800 minus 480,000.
Very good.
820,000.
Yeah.
Second one will be 900, 12,000 minus 576,000. So it will be 36,000.
Really? Okay. Now, fixed costs. Right. Okay, and then profit. Fixed costs, what they tell us about fixed? Not
1
gross.
second.
Net income, okay. What they tell us about the fixed?
Yeah, fixed. They told that it will add 30,400 in fixed
Okay,
cost to the
yeah,
current 200.
okay, so the current is what?
272,000 dollars.
Good. The current is 272. And the new would be?
We add the 30,000.
Right. Okay. Very good, Obaid. You're cooking in bear fat now.
I'm trying to capiche everything, doctor, but
Yeah, you're doing well. You're doing well. Good. Now you can get your net income. So now you can see, is the new one better than the old one?
yes,
So
it appears. Yes, doctor.
what's the problem? By how much? Let's see.
So we. 1 second, doctor.
Yeah.
Okay, 272. 48.
Yep. And the new proposal is no, it's not as good.
Yes. It's not as good. Yes.
No, the new proposal is not as good. Eh? Okay. Stay the way we are. Submit. Let's see if your numbers are right. Very good. Move up. You're right. Right on. So we will not make this change.
Because it seems profitable, doctor, but it appears it's not after you did all the calculation.
The way I am now, I'm making 48,000. Why would I make all those changes? My profit will go down. You see how I use cost volume profit to determine a course of action. Okay, let's go down and see what else they want us to know. They wanted, what's the margin to say? Okay, break even point, current, new break even point. All right, so they say break even point in pairs of shoes. So I need the unit contribution margin, current.
Current.
Okay, well, all I have to do is go to the total contribution right now, obeyed, which is
Okay.
what? No, what's the total current? No, go up. What's the total contribution margin now?
The total, doctor, for now, yeah? Current.
Yeah,
320,000.
Okay. We need the unit contribution margin. How many units did I sell
I
to make
divide
300? Yeah, you divide that by the number of units.
the number of units is
Remember?
24 per pairs.
No. I want the number of units I sold.
The
You're right.
20,000, doctor?
Right. I sold 20,000 and I got a contribution margin of how much?
16.
Yeah. So the contribution margin per unit is 16. Right. Okay. Now do the same. Do the same for they want the contribution margin for the new? What else do they want?
For the new, I think, doctor, yeah. The new breakpoint break even point. Yeah.
Take the total contribution margin and divide it by the number of units.
It will be 14, doctor.
Wow, that was quick. Is that right? Well, you're quick. Okay, let's see if you're right. Yeah, no. You're too quick. Okay, let's do that again. Go back up.
So doctor, I took this number.
300, yeah, and divide it by what?
I divide it by 2,000, 20,000.
Right. What do you get?
Okay. 1 second. Maybe I need to. No.
What do you get? 32 to
second. Divided
Yes.
by 20,000. Still
Yeah.
16, doctor.
Yeah, you're right. Still 16. Why? Okay, what's it saying here? Current
Round answer.
break-even point. Did you round it at all? No, you don't
No,
need to.
it came a whole number, doctor.
Yeah, you're right.
Doctor, here they are asking about the units, not about the
Hey.
not about dollars.
Oh
It's,
no, wait. They're asking, yeah, current break even. Okay. Okay, right. They're asking current break even, not the contribution. Okay, so now I've got the contribution margin per unit 16. You're right. I divide that into my fixed costs. What's my fixed costs?
The fixed cost is 40.
No. Fixed costs. Go to your financial statement. There you got your fixed costs. Right. Divide that by the contribution margin per unit, which is 16.
7,200 divided by 16. 1,700.
Okay, put that in there. Yeah, I was just looking at the contribution margin. And now the contribution margin for the current, you said was 14? Well, then divide that into the fixed expenses to get the break even.
21,600.
Okay. Now let's see if Mr. Wiley agrees. Hey, what? 17,000, not 1,700, right? Yeah,
Yes.
okay. All right, now what do they want to know?
Compute the margin of safety ratio for current operation and after Maria's chains are introduced.
Okay. So the margin of safety is the sales I'm actually doing. So what's the sales I'm actually doing now? Go back up to the income statement. I am actually doing right now 800,000 minus what I need to break even. Okay, but we don't have the break even in dollars. Okay. We need the break even in dollars. So what's the contribution? We need the contribution margin ratio here. Or we could take the contribution margin per unit times the number of units. And give me the mark. I need the break even. I need the break even in dollars.
This is the
And
break even, doctor, I think.
yeah,
Yep.
but it's in units. It's in units. You see, I need
Yeah,
it.
but we multiply it with the 24 per unit.
Very good. No. Multiply it with 40. What's your selling price?
40 to 38.
Oh yeah, 40 is the current. So what's my break even now? 40 times 17,000?
It will be 680,000.
Okay. Okay, now what's my current sales? 800.
800. So divided by 800.
No, subtract. I'm selling 800. I need 680 to break even. So how many more am I selling than I need to break even? 800 minus 680.
Minus 680. 120.
Okay. So what do they want? The ratio.
The ratio.
Now take the 120 and divide it by 800,000.
600,000. 0.15.
Okay, 15. Well, just put 15%. Yeah. Okay, that's my current margin of safety. What's the margin of safety with these guys? Well,
912.
minus, what do I need to
Minus.
break even? 38 times 21,600.
Yeah.
Yeah. That's the number of pairs, and the selling price is 38.
Okay. So it's 820,000.
Yeah.
800. 120.
912.
120. It will be 91,200.
Okay. Now take that as a percentage of 912,000.
1,000. كم طلع هو؟ ضرب 600.
Anybody help him?
I keep forgetting the numbers, doctor, but just give me a second.
Yeah, the selling price is 30.
It will be, multiplied with the 21,000.
600 gives you your
600.
break even in sales. Yeah.
Yeah, it's 820, 800. I deduct that from
912.
900 minus 12,000. It will be 91,200.
Okay, now take 91,200 as a percentage of 912 sales.
900. It will be 10, doctor.
There you go. Okay. Would you make the changes? La.
No.
Okay. There you go. You got it right this time. Good. So you would say no to her proposal. Well, you might say, okay, let's not drop the selling price and let's keep it at 40 and see if we're going to be more profitable. But
no capiche on that one.
You did very well. You did very well. You're learning it. Okay. This one is going to be a little more challenging. Let's see the condensed station, break even, net income, and Susan's plan. Okay. Do you want to get a break, Obaid?
Yeah, doctor.
Yeah, you did well.
One of my students, because doctor, I have to like keep writing the numbers. I don't have a good memory.
Well,
While sharing the screen.
So these questions I do generally, questions I do here is one, I want to make sure you understand the language, so I'll ask you definitions. Two, I will give you problems that have to be solved. Now, I'm not going to give you easy problems. All right? It's like building a muscle. If I want you to build muscles, I give you heavier questions, heavier problems. So
yeah, it's just the so many equation. It needs time to understand which equation, because not all of us doctor comes from like an accounting or financial background. So it's kind of like, we get lost. We need to understand which like equation we need to use in each one.
mm-hmm.
That's the only problem. But I think it's very like attractive and good course. Just need time to like adapt to each class.
Obaid, you did a really good job on that. Now, you struggled, but in that struggling, you learned. Not only did you learn, the people who your classmates are working along with you also learn. Now, if I go to Hisham will go right through this real quick and you're not going to learn anything. You understand what I mean?
We need to make sure Dr. Hisham is actually a human being, because I think he's a human calculator. ما شاء الله ما شاء الله ما شاء الله دكتور. He like he understand everything in this class like 100%. ما شاء الله.
I've taught this for 100 years, a little bit, and always, some people pick it up real quick, real fast. Other people, no. They have to work through it and work through it. But I tell you, at the end of the class, they all get there. At the end of the course, you're all pretty well there. Some have worked a little harder to get there than others. But I'm just asking you. Yeah, Hisham has a good idea, right, Hisham? In fact, he thinks a lot like I do. I think he has an engineering background. Hisham, you have an engineering background?
Yes, doctor.
You do?
ما شاء الله عليك ما شاء الله عليك يا هشام.
Thank you. I'm an electrical engineer.
All right. Okay. I need somebody, another Obaid. Or Obaid, you want to do it? Practice one more time? Hey?
I'll shoot if you want.
Yeah, at least you're volunteering. That's important. Aisha, what do you have to say, Aisha? Okay.
Shall I start?
Okay, who's doing it? Aisha. Maybe he's studying accounting. Believe me, he's not. Maybe he has. All right, this course, I mean, some people say, you know, this is the most difficult course in the MBA, and I can understand that. If your background is not anywhere near accounting or engineering, it can be difficult. But it's not beyond you. You are all graduates. You're experts in certain areas, and you're all going to be, you're studying management. So now you're going to learn how to solve or do an analysis as a manager would. And so therefore I choose, look at the title of this question. Can you see the title, or am I seeing? It says expand your critical thinking. I chose these questions because they're involved. Because you need to think about them. I'm not trying to make it easy for you when I'm working with you. That's the whole idea of my my working through the Wiley with you, is to help you expand your thinking. So now I have a question here. And Aisha, do you want to take it? Does somebody? Let's do the exercise. That's the only way you're going to learn. Now, some people think I'll cram before the exam. No, you don't cram. You learn this stuff a little bit at a time. Okay? So who am I looking at? Hisham.
Yes.
Are
So
you doing that? Is that your Excel sheet?
yes. So I think here it's better to do it on Excel because like we need to segregate the variable and fixed costs.
Yeah, you're right. You're
Okay.
absolutely right. Yeah.
So here we have sales of $1,500,000 for 300,000 units, and the cost of goods sold it's 960,000. The gross profit is 540,000.
Right.
For the operating expenses, we have two selling and administrative expenses that adds up to 555,000.
Does everybody understand what he's trying to do now? He's trying to do what we did. We're going to break the cost of goods sold into fixed and variable, and we're going to break the selling and admin into fixed and variable, and make a CVP income statement, and then move on and do the break even. See, we can't do anything with the statement the way it is. Very good, Hisham. Okay, keep talking your way through. So he's putting it into Excel. And first of all, you got what? Number of units?
Okay. So here I put the number of units.
Okay, sales, yeah.
Here I will make this total.
Right.
In bold, and here unit. Just
Okay.
because in case if I need the this contribution margin in units. So the total sales, we will take it as it is. And
Okay.
for the variable expenses, we have okay, since here the cost of goods sold, it's a mix between the variable and the fixed cost. So here it's saying that cost behavior for the cost behavior analysis, it indicates that 75% of the cost of goods sold are variable.
Okay, wait a minute, Hisham. Under the variable expenses, take away the contribution margin, take that out of there.
Okay, do you want me to?
I want
add-
individual, cost of goods sold,
Okay.
selling and admin. You want the variable, okay?
Admin.
Okay. Now, contribution margin, and then put fixed costs. Well, wait a minute, you're gonna have, you want total, okay. Then put contribution margin. And then put fixed costs and put cost of goods sold, selling and admin. Good. Okay, so now let's go and profit. Total fixed and then profit. Okay. All right, so now, folks, we're going to take the variable, we're going to take the first one, cost of goods sold, and take the actual amount multiplied by the percentage. Everybody has a different number. So take your cost of goods sold, which you have there as what, 750,000? Yeah.
Okay, so now for the cost
Highlight what you're going to multiply, or okay.
So for the cost of goods sold, we have it
Right.
960,000. Okay, so I'll multiply it with 0.75 since it's the variable cost is 75% of the total cost of goods sold.
Right.
So here we'll put 960,000 times 0.75.
Okay.
And for the selling expense, it's saying that 40% of the selling expenses are variable. So I'll do the same thing for the selling expense, 367.
Right.
500 times 0.4.
Okay.
And for the administrative expenses here, it's saying that 94,800 is fixed, and
Yeah.
it's not in percentage. So I will subtract the total administrative expenses with this one. I'll get the variable.
Right.
187,800.
Okay. Now you are not an accountant, so you're not organized. Okay. Good. Now listen. Go up and take the total and unit out of there. Wait a minute. Okay. Right. Take the total and unit out of there. Go up. Take out the unit. Take it out. No. Take out the word unit. Yeah.
Okay.
Take out total. Okay, take the sales and move it into the next column, D. No, just the sales.
Okay.
Move it, okay. And then go down and take the total and move it into column D. Okay. And the contribution margins in column D.
So the contribution margin is simply the total
Right.
sales minus the total variable expense.
Okay, good.
So
now for the fixed expenses, move to the inside column. See, in accounting, when you're going to add, you use an inside column. Okay, never mind. Yeah, okay. Let's go down and finish the financial statement. Okay, cost of goods sold. No, the inside column.
Yeah, for the cost of goods sold, it is 960,000.
Yeah.
Times 0.25. Or you.
No. Oh, 25? Yeah, sorry, you got that right. Yeah.
Or we do 960,000 minus the 720,000. It's the same.
Okay.
So the selling expense is 60%. So it's 367,500 times 0.6.
Okay.
The administrative expense, it's given 94,800.
Okay, good.
So the sum.
No, yeah, the total moved to the outside. Very good. And then you see on the outside, you have the four things: sales, variable cost, contribution margin, fixed, and profit. All right. Does everybody understand what he's done? He's put it into a cost, volume, profit, income statement. We haven't answered any questions yet. but we're going to. Now he's going to say, what do they want? Break even point in units. All right, what I need is my fixed costs, which I have, and I need my contribution margin per unit. So go up and under units, sales, we're going to be how many units?
So here I will do the per unit because I need the contribution margin per unit as well. So I will
Right.
divide this by that. And for the total variable cost, it will be the same. This by the number of units.
Divided by
And
what?
the number of units, which is 300K, 300,000.
Oh, okay, yeah, okay. So your contribution margin is 3 per unit. Your fixed cost is what?
My fixed cost is fixed.
Yeah, so now your break even in units will be that. Right. Will be the fixed costs divided by the contribution margin.
Yeah,
per
so
unit.
for question A, the break even in dollars, it will be the fixed cost divided by the contribution margin per unit.
Okay, and
Which
then your
is
answer's in units. Okay, so put that in down below, yeah.
308,500.
Oh, wait a minute. They wanted dollars there?
Oh, no, they want both. So I will do the other one. So now the break points in unit is 308,500. Now the sorry, here it's in units.
Okay. Now go up and get the contribution margin ratio. You just take the contribution margin as a percentage of sales.
Yes, so for the break even in dollars, it's the fixed divided by the contribution margin ratio. So the contribution margin ratio is the wait, I'll do it here. It's better.
Right.
Percent, and here it is.
That's the variable cost ratio.
64%. So it's simply 100 minus 64.
Yeah, 36. Okay. Divide that in. Now let's see if Mr. Wiley agrees with you. Good.
So it's 1,542.
Dollars.
500.
All right. Wow. Okay, stop there, I'm sure. Anybody have a question for Hisham? Nobody? Everybody understands this perfectly well? Good. Okay, Hisham, you're doing really good. Now, what do they want? Once you got it in a contribution margin format, you can do anything with it. All right, so now.
Okay, so now here it's saying in part B, Sandra has proposed a plan to get the partnership out of the red, so out of the negative, and improve its profitability. She feels that the quality of the product could be substantially improved by spending 0.37 more per unit on better raw material. The unit selling price could be increased to 5.25. Sandra estimates that the sales volume would increase by 25%.
Okay, now we got to work all this again. Okay.
So what I will do, I will just copy paste this down.
Okay, so we go up. Charles.
I will again put it here. Okay. So here she's saying that first of all, the sales volume would increase by 25%. So the quantity will be increased by 25%. So I will multiply this with 1.25.
Right, to get the new one.
Well,
what? You're not gonna, okay.
Okay, so here it's the old unit, number of units, times 1.25, since there is an increase by 25%.
Right.
Okay, what else? Spending 0.37 more per unit on better raw materials. So the variable, so for the variable expense, we will have, so I will remove these and I will make the
Okay.
make the per unit 2.56 plus 0.37.
All right.
Okay, and I will just let me take off these. Okay, so here it will be
What was your variable before? Yeah.
3.2 plus 0.37. Okay, all this here. Okay, and the unit selling price could be increased to 5.25.
So I have a new contribution margin.
New contribution margin would be 1.68. And
All
the
right.
new contribution margin ratio is 32%.
All right, good. So far, so good. Did the fixed cost change? Go back to the problem. Did the fixed cost change?
The unit price, there is nothing about the fixed cost. It's the same.
Maybe I increase fixed selling by 50,000. Well, I got 50. I don't know what you have.
So, sorry, doctor. Just can you repeat it?
Hey, read your question then.
Sandra has proposed a plan to get out of the red and improve profitability. She feels that the quality could be improved by spending 0.37 per unit.
You did that, right?
On better raw material.
Right.
So this contributes to the variable cost.
Yeah.
Or variable expense.
Right.
The unit selling price could be increased to 5.25. So previously had 5, she's increased it by 25%, 25 cents. Sandra estimates that sales volume would increase by 25%.
Oh, I have a different problem.
So there is nothing about the fixed cost.
Number 3, increase fixed selling expenses. You don't have that?
Maybe this is part C. I'm in part B, doctor.
Oh, you're right. All right. I'm in the wrong part. You're right. Okay, good. Continue.
Okay, so here compute net income under Sandra proposal and the break-even point in sales dollars.
Okay, you're right. I was reading C. Okay.
So the net income, let me just do the calculation here. So the total sales would be 5.25 times the new units, and the total variable cost is the unit cost times the number of units.
Right.
And the contribution margin is the difference between the sales and total variable expense.
Okay, fixed costs remain the same.
Okay, so we'll have it 74,700.
All right. So net income 7%. And then what do they want? Break even in
Sales dollars and dollars.
sales dollars. Okay, so I need the ratio and
Ratio
fixed
is
costs.
here. So we have the fixed cost divided by 32, which is wow.
Right.
Basis. So 1,735.
Yep.
2.50.
Okay, check those numbers, see how we're doing.
All good.
Good, very good. No question. Now that's one situation. And now I was reading. Now there's another situation.
Okay, another situation.
Susan, this one's Charles. So the question here is net income. Well, yeah, my net, before I had a net loss of 25.2. So if I do what Susan is saying, I will have a profit. But now Charles, the new marketing manager, what's he have to say? Go ahead. Can you make it a little bigger for me, please? Charles. Okay. Oh, no, you don't have Charles. You have George.
I'm George.
On mine, it's Charles. Okay. George, who's also a marketing manager.
Was a marketing major in college. He believes that sales volume can be increased only by intensive advertising and promotional campaigns. He
Right.
therefore proposed the following plan as an alternative to Sandra's. So his
You have a Sandro. Okay.
so
Increase unit variable selling.
expense to 0.58.
Okay.
So we previously have it like 3.57.
Yep.
Now he increase further to 0.58. Okay. Unit variable selling expense. Okay, the variable selling expense. Lower the unit selling price by 0.30. Increase fixed selling expense by 49,000.
Okay. So
This
go back
question
to your.
anyway. George quoted an old marketing research report that said that sales volume would increase by 62% if these changes were made. Okay, so I'll take the list again. Copy, paste. Okay, so first he's saying that increase unit variable selling expense. Okay,
Yeah.
so he's about the selling expense to 0.58.
Okay.
Okay, so I will take the initial one, not this one. I will delete this, and I'll take the first one. I know you cannot see my screen well.
So I think the second scenario is applied to the first values, correct?
Yeah.
Second scenario.
Yeah, I mean
But-
Richard's scenario.
No, go back to the original. Back to the original scenario.
We are going back to the original scenario because he's saying that he needs to increase the expense of this variable selling expense, this one, to 30. But in part B, we have the total. We didn't do the selling expenses.
Yeah, I mean I think we have to do the calculations like as we have done with Maria case, now with Richard case, like starting from the first values.
Right.
Yeah, from the first one, I will take the initial values and I will apply these changes.
Perfect.
تمام اسلام.
Okay.
تمام خي.
Okay.
So increase unit variable expense to 0.580. So here we have it in this. So we'll increase the unit by 0.50. Okay. So what was the unit? So what I'll do is I will take the selling expense divided by this one. I just want to see the unit, 0.49 plus 0.58 times the number of units. So it will be 321. Okay, here is it clear?
Yeah.
So here I divided the initial selling, the total variable selling expense with the number of units to get the unit. And then I added 0.58 to that unit. And then I multiply it again with the number of units
Okay. So you got the new variable cost for selling. You got the new total, sorry. All right.
New selling expense, variable selling expense.
So what did that do now to your variable cost ratio and your total variable cost change?
Yes, I still need to amend the other things. So here, lower the unit selling price to 0.3. Okay. So here I'll make it 0.3.
Okay.
And increase the fixed selling price by 49,000. So I will go to the sum and I will add 49,000. Okay, so report sales volume would increase by 62%. When I say sales volume, so I need to increase the number of units to
62%. Okay. 1.62.
wait. All market reports that sales volume would increase by 62% if these changes were made. So I don't have to change the number of units now.
Yeah, you do. Your sales volume went up.
I think you have to change it to multiply it by 1.62.
1.62, right.
1.62. Then I will have it 0.3. So I will have a new sales. This one times 0.3.
Mm-hmm.
But I have negative contribution margin.
Sales volume, are you multiplying that with the new selling price?
Yes.
Or check that formula.
Or wait. I did something
Yeah,
wrong.
right.
So it's 5 minus 0.3. Okay. Now it makes sense.
Okay.
Okay. So the net income is 346,880.
Okay.
And the break even in sales dollars.
You got the ratio.
It is the fixed expense divided by the ratio.
Right.
Just this one.
Okay. Then they wanted 2 decimals. 3. Okay. 3.
Three.
Eh?
0.
Okay.
2 decimals and final answer to 0 decimal.
Oh.
Why?
What happened there?
Just a second. 300, 780, 20. I think that we don't need to
Increase the sales volume? It says
increase the
that.
sales volume. Because he's saying that a report says that that sales volume would increase by 62% if these changes were made.
Right.
If these changes were made, the volume would increase by 62%.
Right. And you made the changes.
And I made the changes. So here, I'll try this one. Nope.
Something wrong with that one, yeah. Okay. All right, Hisham.
I'll go back again to here. So 1.62. So the total is 4.7 times the number of units. Cost of goods sold is the same. Selling expense
Went up.
Okay, here I took the unit selling expense, then I add 0.58.
Why? It said the selling expense went up 58%. Why don't you just take the total and multiply by 58? Increase.
Here I took the unit selling expense
Yeah.
and I add to the unit selling expense 0.58. Increase unit variable selling expense to 0.58. Then I
Right.
multiply
Just take the total. You had the total before. Try that. Never mind the.
I
Okay,
had
which
the total before 147.
okay, now
147.
increase that by 58%. What do you get?
Let me see.
1.5.
2322.
Is that the same amount? Is that the same amount you had before? No.
No.
Yeah, put that one in and see what happens.
But here, maybe because I multiplied the selling expense with the number of units, the new one.
Oh, why? No, never mind that. I think that's the problem. I think what they mean, mine reads a little different, but it says increase unit variable costs by not 54, not percent, by so many dollars. I have. What's yours say? Show me your question.
It's here.
Okay.
Increase unit variable selling expense to
By
0.
58 cents, yeah.
Yeah, 0.58.
Right. No, so it's not a percentage. Okay.
No, so this is what I have done here.
Yeah.
I took the initial unit selling expense and I added 0.58.
Right,
As
per unit, and then multiplied by the new number of units selling?
Yes.
Yeah, that sounds right. Okay. All right, Hisham, that is a very difficult question, but for the class, all right, that is a very involved one. Thank you for working that out. But let's move on now, okay? Let's move on to 4, 5, and 6.
Now here what we
And
need
you
to finish it.
Yeah, well, we can work on that. I don't know, because we have different numbers completely. I can't work out where you made the mistake.
So
Never
is
mind. Hey?
Hisham,
yes.
For the variable cost, since the amount of units has been changed, cost of goods sold, selling, and the admin will be changed accordingly. So you will calculate the unit price of the original prices, and then you will multiply it by the amount of the new units, which is 1.6 by 486. This number you have.
1.64, yeah. All right.
Let me try it.
You got my point?
Yes.
Like original you have 300,000. You will
Yes.
multiply it by the amount which is 1.6. This is the amount of units you sold, correct?
So 2.4. So I'll go here. Cost of goods. This one multiplied by this one. And the admin. This one multiplied by this one.
Now keep in mind that also in the variable the selling has been changed to 0.53. Okay, so you will multiply 0.53 by the new quantity.
Selling 0.3.
Yes, I mean, like what was the original unit price?
It was 5. Then we reduced
original selling price. Original selling price.
Yeah, original
selling
5.
Selling expense. Sorry, what was the original selling expense?
147,000.
Original per unit. Calculated per unit.
0.14.
This, yeah, and this one you will add 0.3 to this one, and then multiply it by the new quantity.
0.3. You will add okay 0.58.
Yeah, sorry, I mixed up the numbers because my numbers is different.
So wait, so this number plus 0.58, okay,
Yeah.
بس bracket. I'll just make it here just to see times the new quantity, which is this one. Okay, here I have it 520,202. So I have it the same.
شو اسمه؟
The same.
هشام. Not in the question. It has been mentioned that increase unit variable selling expense to 0.53. So 0.53 is the final. You don't need to add it to the existing one. Sorry, again. Sorry, can you open your question? Yes. 0.58, open your question. Previously, open your question. Previously, it was 0.49, the selling expense per unit, correct?
Yeah.
Now, as per the question, it will be 0.58. Check the question.
Yes, 0.58.
Then this 0.58, you will multiply it by the new quantity. You don't need to add 0.49 plus 0.58. You got my point?
No, they just increased it from 49 to 5.
Here increase to 0.58.
Yes, exactly. Okay.
Okay. So
now you should get some right answers. For the fixed cost, also you have some differences in the fixed cost. That you added this 49,000 to the selling.
When?
Yeah.
Fixed cost will remain the same for all of them except the selling. The selling has been changed by the amount that you have it in your question. How much is it?
Okay, if عندك selling هون it's first 60 per.
Can you open the question please?
It's 60%.
لا افتح السؤال إذا بتريد. خليني بس أوريك. طلع هون. طلع. Increase the fixed selling part number 3. Increase the fixed selling expenses by 49,000. Okay.
So just add it. Yeah.
So the selling expenses that you have in the fixed, it has to be increased by 49,000. This one, yes, exactly.
Right.
Add to it 49,000.
Okay, just let me check this one. Selling expense by 49,000. So what I did here, I added here 149,000.
Okay, it should work.
Okay, let me check.
Now hopefully it will work.
Okay. Zero.
You got one of them, right? And
okay, look, Islam, Hisham, let's move on, okay?
Okay.
Accept the fact that let's go to the next couple of problems. That one was rather involved, and because we all had different numbers, we even have different people in the question. All right, I selected that one as a hard question. It's a little too hard. Okay, move on.
So here, which one? We choose Sandra or George?
No, never mind. Move on. Okay, let's get back to calculating contribution margin ratios and stuff. Okay. All right, read the question.
So, Wild Horse Manufacturing earned net income of 122,000 during 2021. The company wants to earn net income of 62,000 more during 2022.
Okay, right.
So we will add this one.
Right.
Anyway, the fixed costs are expected to be 169 and variable costs are expected to be 30% of sales.
Okay, variable cost is 30% of sales. What's the contribution margin ratio?
Here it's 70%.
Right, a compliment always. Okay, what's the required sale? So now you have the contribution margin ratio. You simply need to calculate the fixed cost and the total profit. Well, you don't need that. Okay. So you're going to take the fixed cost. You got the fixed cost, and you got the target net income, which is going to be 120 plus 62.
Yeah. So the target income.
Yeah.
Is 122,000 plus 62,000.
Right. Okay, now the fixed cost.
Fixed cost is 169,010.
Okay, add those two together and divide by the contribution margin ratio.
It's 0.7.
Okay,
So we'll have, so we'll have it, this plus that.
right, divided by,
So it's 504,300.
okay. Good.
Fill in the dollar amount for the summary income statement for 2022 below based on your answer of part B. Okay, so the required sales 504,300. So I think
Yeah,
so here
just
504,300.
whoa, what's that?
This is the determine the sales to meet the target.
Okay, what are you putting it in net income for? Okay, put it up there under sales.
I thought that this
All right, what's the variable cost ratio?
variable cost is the
Variable cost ratio.
it's 30%.
Right, so take 30% of sales.
504,300 times 0.3, so 151,290.
Right,
And the contribution margin is
subtract those two.
353,010.
Okay,
Fixed cost is given. It was here fixed cost 169.
and the profit then is?
It's simply this one minus that one, 184,000.
And that's exactly what you wanted, right? Good. Okay. All right, that's the target net income. So you simply add it to fixed, and usually divide by the contribution margin ratio.
Yeah.
Okay, so the next,
In
again,
September,
contribution margin unit and ratio again, yeah.
okay, so here we have number of units sold, 850 units. Okay, the average sales price was 45. Sales 45. During
Okay.
the month, fixed costs were 8514. This is the fixed cost.
Right.
And the variable cost, 60% of sales. Variable cost is times 0.6.
Okay, so now you got the contribution margin ratio right off the bat.
It's 0.4. It's 40%.
100 minus, yeah.
Which is 45 minus 27.
What? What's that?
This is the in dollars. So I'll just mention here 100%, 60%, and 40%.
Wait.
Oh.
Show me that again.
This is
Oh,
contribution margin
right.
in dollars.
Okay, I thought you said 30%. Okay, good. So put in 40% right there, down below contribution margin ratio, 40%.
So here it's 40%. The unit, the contribution margin in dollars is 818, and the contribution margin per unit is this one divided by 850. Is it?
0%.
0.02. Wait, 45. The average sales price was 45. Sorry.
Yeah, what are you doing?
It's wait. I did something stupid.
All right.
So here it's 18, and here it's 18 times. What was
Every unit.
850? It's here 15,300.
Okay. Good.
Okay. Now use the contribution margin technique, compute break-even, sales dollars, and sales unit. So for the break-even in dollars is the fixed cost,
Right.
divided by the contribution margin
Ratio.
ratio,
Right.
which is 21285. And for the
Okay.
break even in units, it's the fixed cost divided
Divided
by the
contribution.
contribution margin per unit,
Right.
473.
Good. Very good. Okay, looking at the problems a different way now.
Okay, Crane Bucket Co., a manufacturer of rain barrels, had the following data for 2021: sales
Okay.
quantity, unit selling price, unit variable cost, fixed cost. What is the contribution margin ratio?
Okay.
Okay, so I'll add it here as well. I'll add everything. Sales, variable cost, fixed cost, or here I'll write contribution margin, fixed cost, number of units, 2430. Okay, let me check here, 2430. So here it's 50, and here it's 35, and here it's 18,225.
Okay.
And this
Your
one is
contribution margin is, 50 minus 35, 15. Okay.
and 35, 50.
Good.
70%, and here it's 30%. Okay, so the question is asking for what is the contribution margin ratio? It's 30%.
Right.
One, what is the break-even point in sales dollars? So the break-even point in sales dollar is the fixed cost divided by the contribution margin ratio, which is 60,750.
Okay.
And what is the margin of safety in sales dollars and as a ratio? So this is break-even in dollars. Okay, so the margin of safety in dollars is the break-even.
It's the sales. It's the sales minus the break even.
Sales minus break-even.
You don't have the total sales yet.
Yes, so the total sales is this one times the quantity.
Right. So
Okay.
it's that minus the break even.
So it's this total sales minus the break-even, and
that's
the
your dollar value, and then you take the ratio. Yeah.
ratio, it's this one divided by the total sales.
Right. 50%.
60750, and here it's 50%. This is a good ratio.
Very good, Hisham. Very, very good. And Islam, thank you. All right, class.
We still have one
You
question.
can see how there's one more thing. Okay, what did they want?
If the
Total
company
increase in sales required. Okay.
by 30%, by how much will it need to increase its sales dollar if all factors remain constant?
Okay, well, the increase its total contribution margin by 30%. Okay, so go back to your thing and get your contribution margin, increase it by 30%.
So this one?
No, you want the total contribution margin. Take 30% of sales to get the total.
I didn't understand the question. If the company wishes to increase its total dollar contribution margin by 30%
Right.
in 2022, how much will it need to increase its sales dollar if all other factors remain constant?
Okay.
So here we already have the contribution margin ratio 30%.
Yeah. Okay. It's
So
going to remain constant. Okay, so now get the total contribution margin. Right there. Okay, what's the total?
36,450.
Okay, they want to increase that. by 30%.
Ah, okay. Okay, I got it.
Okay, so now the sales, what will the sales have to go up to?
Okay, so
Okay.
we simply do this
Yeah.
divided by the contribution.
1.3. No, not by that. By 1.3. They want to increase it by 30%.
Oh, yeah, 1.3.
So what kind of new contribution margin do they want?
So 28, but this one will decrease. Well, times 1.3.
Yeah.
47,385.
Okay. Now go back to the question. Okay, so you increased it by 30%. By how much will it need to increase its sales dollars if everything else remains the same? So now what kind of new sales dollars am I going to need to get?
Okay, so we will, what we will do
Yeah,
is
yeah.
we will subtract this from the,
Oh, divide that by 30, yeah.
or divided by 30, yes.
Gives you new sales dollars. What do you get?
157,950.
Okay, but it says how much did it increase? So now subtract that from what you actually have now.
15 minus 121 is 36.
So that's your answer. So how much does sales have to increase if I increase my contribution margin?
Total, okay. I didn't understand the question very well.
Okay, well, that's the way I understand it. Let's see if Wiley agrees. Yeah.
Agreed.
You understand?
Yeah, so they want to know actually that if you increase the contribution margin by 30%,
Right.
what would be the difference between the current and the new and the increase?
Well, the sales will increase by that amount.